From New York City for our viewers worldwide, I'm Jonathan Ferrer with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, the US payrolls report delivers. Jobs increase more than expected and unemployment drops to a 16-year low. Former Fed Chair Alan Greenspan says there's a bubble, but it's not in equities, it's in bonds. And Hertz leaves investors flying blind. The auto rental company gives bond traders the silent treatment. We begin with a big issue, a solid jobs report in the United States.
This is a very fine report.
These are good numbers.
It's a rather strong economic report, but I don't think it moves markets much.
The unemployment rate ticking down, labor force ticking up, the wage number beating expectations. So the recovery is continuing. I
think until we see a lift back to 2% in terms of the core inflation rate, the Fed probably begins quantitative tightening, but won't raise short-term rates this year.
The one thing that we're really not seeing, it was commented on this morning, is wage inflation. So why aren't we seeing wage inflation despite the fact that the economy is strong?
We would obviously like to see some wage inflation in the system. Wage inflation means that we're putting more income in consumers' pockets. When consumers have more income and then we lower their tax rates on top of that, they'll have more money to spend, driving more and more economic growth. So that's really what we want to see.
Joining me around the table in New York is Michael Collins, Senior Investment Officer at PGIM Fixed Income, Priya Misra, Head of Global Interest Rate Strategy at TD Securities, and joining us from California is Nick Maroutsos. He's Portfolio Manager at Janus Henderson Investors. Guys, great to have you with us. Let's begin with you, Priya, and talk about the Federal Reserve. It's a solid jobs report, but it doesn't really move the dial for them, does it?
I think for the portfolio runoff, it's already baked in the cake. They've already told us they were almost not really data dependent. But I think for the hike in December or further on for the entire hiking cycle, I think it does move the needle. I know the market didn't react as much, but you're seeing signs that the labor market slack is slowly going away. And I think most importantly, we saw signs that wage inflation is picking up. So all this weak inflation data that we've had in the last 3-4 months, I think the Fed can afford to ignore it if wage inflation is picking up, because they can say, look, this is one-off, wireless and vehicle prices, but wage inflation's picking up. That'll allow real incomes to rise. So I think the probability of a December hike, which was 35% pre the number, I think we're looking at least at 50%. And the reason I'm not higher than 50, I just want to see how portfolio runoff, how the market handles portfolio runoff. If financial conditions remain easy, which they're remarkably easy right now, I think we might be getting a hike in December.
Michael Collins?
Yeah, I think they should hike, right? If I were them, I'd hike in September before I start tapering the balance sheet, right? Because our view has been the more they taper the balance sheet or reduce the balance sheet, it's effectively a tightening of monetary policy, whether they want you to believe that or not. And the further that goes, it lowers the probability that they'll be able to hike. And I think they should get as many bullets in their chamber as they can so they can cut in the next recession.
I mean, I'm looking at the jobs report, and the base case that I gauge from investors right now is sure one more hike at the end of the year. The real unknown seems to be next year. Nick, Morgan Stanley looking for about 4 interest rate hikes in 2018. We put that question to Steve Mater of HSBC earlier this week, and he said good luck with that. There seems to be a huge spread on what we can expect from the Fed next year, given that we don't even know who the Fed chair will be. There's a lot of unknown coming up, isn't there?
That's absolutely right. And I think we are in an environment of unknowns. And if you look at the Fed, let's look at their track record. So in 2015, they predicted 4 interest rate hikes, they did 1. In 2016, they projected 4 interest rate hikes, and they did 1. In 2017, they predicted roughly 3, and it looks like they're on a path to maybe achieve that, but I'm likely to take the under of that relative to what Priya and Michael are saying. So if we look at 2018 as a sort of a guide, our guess is that the Fed is likely to overpromise and underdeliver, typically of what they've done previously.
Priya?
So I think for next year, the big question is going to be the terminal rate. I think we have to think about this hiking cycle as a normalization versus, I guess, Michael, to your point, tightening. I think when the funds rate is 1.5, 1.7, your real your real rate is essentially 0. Now we go into the tightening mode. I think normalization, they're absolutely going to hike a few more times. But is R star actually rising? So the people who are calling for 4 hikes are arguing that yes, you want to actually tighten, I'm not so sure that they need to have.
I mean, I'm looking at the dot plot on the screen right there, and typically we know how this evolves. The market's down at the bottom and the Federal Reserve kind of gravitates towards the market. Now, Nick, earlier this year, the market was actually led by the Fed. Very briefly, it just feels like the Federal Reserve has lost conviction over the last couple of months on their own forecasts. Do you anticipate the dot plot, so to speak, is about to gravitate down towards the Fed's view of the market's view of the world?
It has to, and that's a matter of fact. I mean, if you look at what forecasting has done over the past, let's say, quarter of a century, the markets have consistently got the market wrong in the sense that they projected rates to be higher. In most cases, rates finished lower throughout the year, and I'm talking about overall rates, not necessarily just the cash rate. So we are in an environment where we live in a world of doves. Let's look at the market environment. You have data that's weak, inflation that's weak. You have many central banks globally walking back on hawkish remarks. You have them moving off of potential rate hikes. Accommodation is here to stay, and while we may be unwinding it over time, it's going to take time, and that's what I think people need to realize. A lot of people are calling for the bond bubble to end or the bond bubble to pop. We're not there yet. We are in an environment where there's going to be lots of accommodation. It's going to remain, and rates are going to stay relatively range-bound for the foreseeable future.
Yeah, we think the neutral real funds rate, as you put it, Priya, isn't +2 like it used to be, many decades ago when we were trying to get inflation lower.
Yeah.
Now we think we're going to be in an environment over the next 5, 10, 20 years where we're going to be trying to get inflation higher, fighting deflation. So the real neutral funds rate is probably -1 to 1 right now, meaning the nominal funds rate is probably kind of 0 to 3. And you're in the middle of that right now, and I think 3 is really tight policy, and that would drive us into a recession.
Well, we're sitting here trying to work out what the economic data means for the Federal Reserve and what policy there ultimately means for markets. And a lot of people would sit at this table and over in the trading floors and say that DC no longer matters. But the price action of yesterday, Priya, earlier this week, really struck me. It looks like the Russia probe is deepening in the eyes of a few investors, and the curve bull flattens.
Right.
And when the curve bull flattens, it was kind of a signal to me that for some people there's still some upside risk baked into the long end for what we might get from DC. Do we need to fade all of that out?
I think there's a little bit of it in the rates market, but in the equity market, in the risky asset market, I think there's absolutely a lot of that Trump premium priced in. Now, it's not just taxes. I think it's taxes, it's deregulation. Now, what you can have is if that gets derailed because we get some more tape bombs or we have the investigation becoming more difficult, I think then equities here have a lot of downside. And then how do you buy 5-year notes if that happens? We're buying further out the curve because it's just a lot more yield. I think it derails the Fed hiking cycle next year if you do have that much dysfunction.
Nick, it makes me wonder, you sit here and you look at a 30-year at 284, and at the start of the year people would have said that was going to go materially higher. Is that actually a buying opportunity in some regard?
Look, I look around the world and I say, okay, U.S. yields stick out. And the reason being is you have Japanese yields that are yielding roughly 10 basis points. You have German bunds that are yielding roughly 50 basis points. Foreign demand is going to consistently go out and purchase bonds, whether it be in the 30-year part of the curve or the 10-year part of the curve. If I'm a foreign investor, I'm basically licking my chops going, yeah, I'm happy to get a 2.5% yield if I can. Whereas globally, if I'm sitting in my own country and I'm earning 0.5% or 10 basis points. So I think there's going to be a natural pull of rates keeping down, even though some of the data may prove, or even maybe some of the rate hikes may prove to push rates up. We're going to be in an environment where rates are going to stay range bound.
Priya, just quickly.
I think the one point here that's potentially a risk is, does the Treasury come out with 50-year, 20-year bonds? And certainly this week there was talk of that. I think the market expects it. I'm not so sure as a taxpayer that I want them to issue.
Of course.
So, if the issuance, as the Treasury tries to fund the Fed portfolio, if the issuance, which we think is bills out to 5s, I absolutely agree with Nick that there's value. But there is a risk that the Treasury decides to extend the average maturity a lot more. And that's when, there's always demand from the rest of the world, but at what price? Maybe you want a little more price of supplies.
Mike Collins, do you really think the average maturity is going to change over with Treasuries? I mean, we look at it right now, it's about 70-something months. Right. You look at the UK, it's like 160-something months.
Right. I mean, if I were an issuer of debt, or borrower of money, I would want to be in the front end of the curve, right? Because it's consistent with our view that the Fed is not going to hike that much. The lowest yields are going to continue to be in the front of the curve. I think it's expensive to issue in the back end, especially if you issue a 40 or 50 year at a premium to where the 30-year trades.
Michael Collins from PGIM Fixed Income, Priya Misra from TD Securities, and Nick Maroutsos from Janus Henderson Investors will be sticking with us. Coming up next, the auction block, Iraq's first unsupported bond in more than a decade, proving the thirst for risk and yield is very real. You are watching Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I want to head to the auction block now, where there is an appetite for long-dated bonds by blue chip companies. Last week, AT&T. This week, GM. The automaker sold $3 billion of bonds. The longest portion of the four-part offering was a 30-year bond with yields around 2.55 percentage points above Treasuries. The United States Treasury said this week it will maintain the issuance of longer-term debt at $62 billion. Officials continue to be studying the introduction of ultra-long bonds and predicted future borrowing needs will increase as the Fed begins to shrink its balance sheet. Then elsewhere, an eye-catching debt sale that got a lot of people talking. Iraq sold $1 billion of bonds due in 2023 at a yield of 6.75%. Investor demand was massive, with orders almost 7 times the issue size. Some in the market pointing to this Iraqi offering as a warning sign of a potential credit bubble, a debt bubble. A bubble is something that former Fed Chair Alan Greenspan also spoke about this week. He told Bloomberg, by any measure, real long-term interest rates are much too low and therefore unsustainable. When they move higher, they are likely to move reasonably fast. We are experiencing a bubble, just not in stocks, but in bonds. This is not discounted in the marketplace. With me to discuss, Michael Collins from PGIM Fixed Income, Priya Misra from TD Securities, and Nick Maroutsos from Janus Henderson Investors. Priya, what is a bond bubble? What is that? How do we define it?
So a bubble essentially would be you've got fundamentals and you've got pricing that widely is different. I would argue there is no bond bubble. I mean, unlike equities where you've got a string of cash flows, it's harder to see it in bonds, but we've got a series of cash flows in bonds. And if I would argue the reason I don't think there's a bond bubble is if you look at the funds rate, if the funds rate going to end at, and I have people telling me 1%, our view is closer to 2, but if the funds rate ends at 2, then it's 2.25 in the 10-year, really that much of a bubble. So there's absolutely the Fed hiking cycle component of that, which I think the market's pricing a fair hiking cycle there. Then the other part is term premium, which is demand from the rest of the world. That's significant. Now, if you tell me that Draghi is going to be extremely hawkish and bonds are going to be much higher, sure, but is that a bubble or is that a repricing? So I sort of disagree with this idea, but obviously there are views across the board on whether
there are. So Mike Collins, here's how I think about it. I think how will we look in 10 years when we look back 10 years? How we look at that massive bulk of bonds with negative interest rates from nowhere? How will we think about these governments that managed to issue all that debt with a negative yield? And how will we think about all these companies that managed to issue all that debt with zero interest rates? Are we going to look back at that and say, what on earth?
One perspective is that in 10 years we'll look back and say, oh my God, I wish I bought more of these long-term Treasury bonds at almost 3%, right? Because somewhere between now and that 10 years, we're going to have a recession. Yeah. And in that recession, our 10-year isn't going to be at 2.25. It's probably going to be at 1.25. Our funds rate will probably be at 0 or even negative. So it's going to be a roller coaster ride between now and then. And I'm, looking at Alan Greenspan. I feel like he's having a flashback, right? Like he's talking about stagflation the other day. Stagflation is when you have weak economic activity and high inflation. We have just the opposite. We have strong economic activity and very modest inflation. And, he's talking about real yields need to be positive. I think that's the world we lived in again. And I think in the future, real yields on risk-free assets, I don't think they should necessarily be positive.
Priya?
I agree with you entirely. I think that 10-year question depends a lot on inflation. If inflation's a lot higher, absolutely these prices are mispriced. But I'm not so sure with technology, with the gig economy, with these firms that are becoming larger and larger and, the share of labor is declining, I'm not sure inflation's really about to take off.
Nick, this story about there being a bond bubble, the idea that Argentina can come to the market and issue a century bond, that Greece has come to the market and got debt away at a decent yield, that Iraq has an offer that's 7 times oversubscribed. When people come to you with those issues, what do you say back to them about your own thoughts?
Look, I think there's massive complacency in the marketplace. We have this insatiable thirst for yield. There's lots of uncertainties, and people are engaging in risky behavior. Why? Because they're trying to replicate returns of yesteryear. They're trying to get those 5, 6, 7, 8% returns in fixed income. How do you do that? You have to move down the credit spectrum or move out the maturity curve. When we look at Iraq, you know, I'm sure Iraq's looking at themselves saying, let's get into this game, and why not? It's a perfect condition to issue new debt and lock in low rates. Let's look at where we were 2 years ago. Iraq tried to issue debt in 2015. However, there was a decline in oil revenue. There's a war with the Islamic State. There was government instability, and the market was pricing somewhere around 10%. They did end up issuing about $1 billion last January, but that was government guaranteed, U.S. government guaranteed. 2 years later, what we found? Greed trumps risk. So people are so thirsty for yield, and there's this fear of missing out that, like you said, it's 7 times oversubscribed and over 3% tighter. And I'm not saying that that risk is inappropriate, but if there's a flight to quality, it's not going to be to Iraqi bonds. This is a slippery slope, but I will say, like Priya and Michael have been saying, Greenspan's essentially doubling down as his comments made from 2 years ago. Yeah. The reality is that this stock bubble is a result of a bond bubble. Welcome to the magical world of quantitative easing.
Absolutely, and I think many people watching this program would agree with you. Mike Collins, the way you look at it right now, though, that maybe things are frothy in credit and it's time to really load up on sovereigns and to pivot back towards that space.
Yeah, you know, it looks like at this point in the cycle, and you could argue it's getting late in the cycle, if not late in the cycle, it feels to us that a lot of investors are piling into credit, right? They're going down in quality. They're giving liquidity. You hear a lot of talk about private debt, right? Levered private debt to get 8% returns. They're going down in capital structures, in structured product. They're doing things you're not supposed to do later in the cycle to get that extra yield. And we are definitely going the other way. We are definitely upgrading the credit risk in our portfolios, reducing exposure to some of the...
Does that include buying a Greece type issue?
You know, in some cases it does, right? So in some cases we're reducing exposure to corporate credit risk, where there's a tremendous amount of churn happening within each industry, right? And it feels like this pricing pressure, meaning inability of companies to raise prices, is spreading across a variety of industries, and it's causing problems there. So we're fading that. And you look at Greece, and you could argue that they are fundamentally improving, right? That in 3 years from now, they'll probably have higher ratings than they do today.
To be long the periphery at a time the ECB is set to pull back a little bit, that's brave, Mike.
You know, I think they're going to pull back really, really slowly. If you think the Fed's tapering is going to be like watching paint dry, you know, the ECB first has to get down to 0 purchases, which could take a year or a year and a half. And then they have to figure out how to get that negative 40 basis point yield to 0, which could be more years.
Michael Collins from PGIM Fixed Income, Priya Misra from TD Securities, and Nick Maroutsos from Janus Henderson Investors. Staying with me. Let's get you a market check on where bonds have been this week. 2s, 10s, 30s in the Treasury market. Yields lower at the long end. We are down by about 5 basis points on a 30-year. Unchanged on a 2-year note. 10-year yields creeping down 3 basis points on the week so far. Still ahead, the final spread. The week ahead featuring bond investors are looking for answers from Hertz. We'll get into that in just a moment. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, OPEC and non-OPEC members will be meeting in Abu Dhabi to discuss compliance with production cuts, plus a Mexico rate decision, US CPI data, and earnings from, of all places, Hertz. You might be asking yourself why we're highlighting Hertz this week. Well, the company spooked bond investors over the past week, the company disclosing that it wasn't going to use the proceeds of a recent sale of senior debt to buy back existing subordinated bonds, as it had previously indicated. Hertz didn't give a plan for what it was going to do with the $1.25 billion from the senior bond sale from just 2 months ago. Still with me, Michael Collins from PGIM Fixed Income, Priya Misra from TD Securities, and Nick Maroutsos from Janus Henderson Investors. Mike, in the consumer discretionary space in high yield, this is the most traded debt. The volume of it is ridiculously high. Everyone's talking about it in the credit space. If someone put that credit in front of you now, what would you be saying back to them?
Well, I mean, it's highly traded because it's exciting. There's a lot of news and a lot of volatility, right? The markets are looking for volatile stories that they can trade around a little bit in light of the low volatility environment. Earlier this year, we actually reduced exposure to the auto rental space, auto rental asset-backed space, even the auto space and the auto supplier space to some extent, because it looks like that whole sector has maybe already peaked this cycle.
Nick, your thoughts?
I would agree with Michael. I mean, I think we're looking, I'm a bond investor, right? And I'm looking at capital protection, some form of income generation. You know, I want to have that stability in my portfolio where we can collectively just accrue income on an ongoing basis and sleep at night. We're not the type of people that are going to be chasing returns, and I think that's what's happening in this environment. Is you're seeing more and more people and more issuers issue debt, lock in low levels of rates, and people are willing to buy that because they need return.
Priya, the auto sector has been fascinating for many people, and the credit guys are really trying to find what the trade is to play off the back of it. I think the guys in macro looking at treasuries have all of a sudden started thinking about auto sales as some kind of read-through as to what the strength of the consumer is. What are your thoughts on that right now?
They have, absolutely. I think this week the market reacted to the weaker numbers. If you look at my terminal, I'm showing you the auto sales seasonally adjusted annual rate, which has been falling off. Now, I think we expected it. I mean, you know, with high replacement value of cars, people are not changing cars that often. That 18 million was a pretty high number. It's been falling off, but I think what the market's now worried is you've got the Fed that's tightening, normalizing, and you've got inflation that's not looking that hot. Well, what if growth is falling off as well? So they're using any leading indicator, and this is the leading indicator of consumption.
Well, Mike, let's be clear. You don't look at that chart right there and read across a weak consumer, do you? Or you're just saying it's weak for this specific space in credit?
Yeah, you know, I think the consumer is actually in a great spot still. The consumer is pretty solid. That being said, the underlying trends among consumers is changing really quickly, right? I had a meeting yesterday with a bunch of young, women just entering the workforce. I said, do any of you have cars? Absolutely not, right? Millennials generally don't own cars, right? It's a different environment for consumer products companies. Like I said, there's a lot of churn and a lot of things going on, but there are a lot of other sectors you can pull up. Housing, to some extent, looks like it maybe is a little toppy. Construction looks a little toppy. Job gains look like that chart we just showed, right?
Guys, we're going to wrap up the program just now with a rapid fire round. You know how this works. We take it back through the whole week and the last 3 segments and wrap it all up into 3 questions. 1-word answers, please. Lowflation forever or stagflation around the corner? To you first, Michael.
Lowflation.
Priya.
Lowflation.
Nick.
Ditto. Lowflation.
If Greenspan was a trader, would you take the other side? Michael.
Yes.
Priya.
I would.
Nick.
Absolutely.
Would you buy the 2023 Iraq bond or the Hertz note of a similar maturity? Michael.
Wow. Yeah, maybe the Iraq bond.
Priya.
The Iraq bond.
Nick.
Wow, that's a tough one. I'd probably stick with the U.S. and go with Hertz.
Guys, we've got to leave it there. Michael Collins from PGIM Fixed Income, Priya Misra from TD Securities, and Nick Maroutsos from Janus Henderson. From New York, for our viewers worldwide, you're watching Bloomberg Real Yield.